Recession is in the news more and more these days, which is something no one wants to see. At the moment, 59% of Canadian economists think that our country will be in a recession by the first half of 2024. So let's take a look to see where the Canadian economy is, what we might expect, and how a recession might affect Toronto real estate in this video. If you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you see more videos like this made specifically for real estate investors in Toronto. I'll first share where the Bank of Canada thinks we stand right now. Basically, in a speech made in the middle of May, the Bank of Canada said that we are not in the same situation as where we were in the 70s. We're not in a stagflation situation because we're not in a recession. Instead, our GDP is growing both year over year and month over month, which shows that our economy is actually doing very well. The other sign that our economy is doing very well is that our unemployment is at its lowest level ever. Canadians are still pretty wealthy and have more money saved up than usual, which is why our spending keeps going up. When you add this to the problems with supply chain caused by COVID and the extra shock to commodities caused by the war in Ukraine, the Bank of Canada calls our current situation the perfect storm. And this is why we have a big problem with inflation right now. The Bank of Canada has a really hard job ahead of them because they're trying to land in a very specific spot. They want to get rid of the extra demand from COVID so that we can cut wages, prices, and corporate growth to bring down inflation, but they can't cut demand so much that normal production drops and tanks our GDP. Now, I know a lot of people think the Bank of Canada moved too slowly and was too naive to think inflation was temporary. In all honesty, things just look clearer when you look back. The most important thing is that the Bank of Canada agrees that inflation is a big problem and has been changing their inflation projections every quarter, as you can see in this chart. Right now, we can expect inflation to last for a longer period of time and hopefully peak very soon, but it is much harder to control. Now, going back to where we were in the 70s and 80s would be very bad for us. So let's see how we stack up. As you can see, inflation is at its highest level since 1981. And also, the CPI is higher than the GDP, which is similar to what happened in the 70s and 80s. But let's see how different we are right now. As I've already said, our unemployment rate is a key sign that our economy is much stronger. Right now, unemployment is at a record low, and this is a big change compared to the 70s and 80s when unemployment was much higher. The second difference is the direction of our GDP. During the height of inflation in the late 70s and early 80s, the GDP went down, showing that the economy was slowing down. Right now, our GDP is still growing, so that's a big difference. The third difference could be that as COVID comes to an end, they naturally balance out supply and demand, bringing down inflation. As people recover from COVID, they're going back to work and factories are opening up again. People are naturally moving from goods to services, and all of this will help cut down our excess demand over the last 2 years and bring up our supply. If we end up with interest rates in the double digits, real estate will definitely crash, but the Bank of Canada has already come out to say that they've made that mistake before and it's not going to happen again. Most likely, overnight rates will stay between 2 to 3% in the long run, but they could go a little bit higher than 3% if they need to in the short term. This gives us hope that if there is a recession, it would be more like the recession starting the 1990s, where the real estate market stayed strong and stable, and that would be a much better case for us. If we do think that over the next year, overnight rates will get to the upper limit of neutral rates, which is at 3%, this is a big jump from where we started, which was at 0.25%. Variable rates are around 1.5% higher than overnight rates, so that means variable rates might end up going to 4.5%. If and when that happens, we think the end user real estate markets in Toronto will act pretty different compared to investment markets. First, let's take a look to see how the numbers change for end user homes. When variable interest rates were at 1.75%, the monthly mortgage on a $1.5 million home was $4,300. When variable rates reach 4.5%, the monthly mortgage payment will go up to $6,100, and that's an $1,800 increase in monthly costs, which ends up being too much to handle. So monthly mortgage payments will likely have to go back down to $4,300 per month, which means prices would have to go down to $1.05 million, or a drop of 30% on the end user side. On the investment side, we can use the same $1.5 million purchase, which can buy a house with 3 separate units. When rates were at 1.75%, this house generated $1,400, which helps act as a buffer when interest rates go up. But even so, when variable rates reach 4.5%, it still creates a negative cash flow of $350. Most real estate investors don't like having negative cash flows on a freehold, so the price of investment properties will likely have to go down. But because of that bigger buffer to begin with, it actually doesn't have to go down as much. Basically, prices would only need to come down to $1.4 million for cash flows to stay a little bit positive, which ends up being a 7% drop in prices. The negative effect of rising interest rates for end users ends up being much bigger, so we might end up seeing more end users put off buying and rent for a longer period of time, which ends up being good for investors and the rental property market. If we end up going into a recession, interest rates might go down a bit, which ends up also being good for investors. The last thing to keep in mind is that most people who invest in real estate do so for the long run. Even if an investor bought at the peak in February, their cash flows are probably still pretty stable. What happens is that the interest portion of the monthly mortgage payment goes up and the principal portion of the monthly payments go down. In other words, cash flows stay pretty similar and they end up having very good holding power. So if you think about this, whoever's selling right now in the current market is probably a lot more motivated than the average seller. It could be because they bought another home somewhere else and they need to sell their current one, or because they inherited a home and they just want to cash out, or because they have other financial or personal problems, or because they have a strong view of the market and they want to take profit or stop losses before they think the market will crash. This means that you can get a very good deal if you meet the right seller who's willing to sell for less than how much the property is worth. Last but not least, because interest rates are going up so quickly, it might be best to focus on investments with better cash flow like freeholds right now. But of course, what you choose to invest in will depend on your own situation. So let's chat if you want help figuring out how to invest in Toronto real estate. We can take a look at your requirements and preferences and then match you up with the best investment property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.